Once again, thank you for coming. Today's session is very long. It's about 77 slides. So I don't think I can cover in one day. So whenever I stop, I'll start tomorrow. I'll recap and I start tomorrow or on Tuesday. So please do come. I don't think I will be able to complete today, but I'll try. There are 77 slides. Okay, so in this presentation, I'm going to teach you how I trade, what strategies I use, and how I provide my services to other members so they can follow me easily. So this is what it's all about. It's not 100% complete detail of everything I do because I cannot teach you in just 2 hours of what I do, what I learn in 15 years. But I'll try to give you the glimpse. So it's like a overview, preview. So early on when I was starting, I I still have mentors, coach mentors. So one of the mentors, when I was starting, I was getting into a lot of things in trading. So he advised me, hey, Noshi, don't just jump around and learn everything or try to trade everything. Just focus on few things. So master it. So I believed in Bruce Lee. When I was young, I used to watch his movies. So he gave me this advice that practice one kick 10,000 times till it you go like go on the in the flow. So the moment you see it, you know it. So this quote by Bruce Lee, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So keep doing the same thing again and again and again. So that's what it is. Keep doing same thing again as long as it's working. And if it doesn't work, then it means it's not you, it's something else. So you have to ask question. If it's not working, it was working. So what changed? Did I change? If the answer comes no, I did not change. Did I change anything in my system? So you say no, I did not change anything. So why it stopped working? So what happened? So it's something else. Maybe it's you, maybe the market. So mostly it's the market because you're changing very slowly. So you're changing very slowly, but the market is changing very fast. So if something stopped working, if your kick doesn't work, it means something outside of your control has changed. Another thing I learned from him is that uh, there are 9,000 stocks. So 9,000 stocks are moving up and down, but we are not interested in 9,000 stocks. We are interested in the stock which are getting bought or being sold. So getting bought and being sold. We are just little boys following the big boys. So the big boys are like dinosaurs. So they are leaving their footprints. So we need to figure it out how to read their footprints. So it could be a technical, it could be the volume, and it could be the key levels. So there are many things I will explain to you. I have prepared a lot of slides, so I'll show you some. So following the dinosaurs. So dinosaurs can run but cannot hide their footprint. So try to detect these dinosaurs. So they're very smart. They have a lot of resources. They have a lot of money behind. So they are very smart, a lot of resources. They have the knowledge up to the second. They have uh, inside news. So we say that inside trading is illegal and all that. That's bullshit. People have inside knowledge and they do make money. So it shows in the chart. So inside trading, they are doing it. They know the news. They expect what's going to happen. So by the time the news come to us, it's too late already. The news is already out, and they're paying. They have all the resources. By the time the news come to us, it's too late. So so when the stock is moving, there is a reason for it. So you need to trust that there is something behind. I don't need to know right now. I need to shoot first, ask question later, and you're believing in whatever you're shooting is right. It's not like, okay, I shoot and then things go wrong, I'll take my losses. So it's not like that. Another thing you need to do in order to be successful or anyone is to prepare. So prepare, prepare, prepare. So I prepare. I used to prepare by myself. Now I have a team, so I have dedicated or delegated the task to them. So they prepare for me, and then I prepare. So they prepare, then I prepare, and then I work with them during the whole trading hours, before the market opens, during the market hours, after the market hours. So everybody has assignment. So give you the gist that we cannot trade 9,000 stocks. So I've broken down the list into the stocks into different lists. So I call it hardcore stocks, core stocks, non-core stocks. So hardcore stocks are those stocks, those 200 stocks which are moving during the day. Something is moving. So sometimes it's Baba moving, sometimes it's Baba, Baidu, JD, Billy. They're all moving together. All four are moving for a reason. So when that happened, then I say, okay, all four are moving for a reason. Now let me see which one I need to choose. Sometimes it's all four, and all four turns into winners. Sometimes it's one, and then the next day is another one, and then after 2 days, something else wake up among the Chinese stock, and they start moving. So I prepared a list like that. I prepared Home Depot. If Home Depot is moving, let's see if Lowe's is moving. Caterpillar moving, yes, Caterpillar moving. Apple moving, let's see if Meta moving, or what is moving. Nvidia moving, then AMD moving or not. Where is AMD? Yeah, Nvidia is here, AMD is there. So which one is good for me at this time? So all that preparation is done in, and I call it hardcore stocks. So those 200 plus stocks I must have, and I'm always on the lookout to add new stock. So the stock which was not hot yesterday, today is hot, and I add it. So I run the scan on 9,000 stocks, but I'm not trading all those nine. I'm just trying to, during the day, if I can find one stock to add to my existing list. So I don't want to miss in the future. If I miss it that day, it's okay, but I go and add that stock. Sometimes the stock just disappears because of the merger and acquisition, or it lost so much that it turned into, it used to be $200 stock, now it's a $2 stock. So I don't want that $2 stock in my list. So I remove it. So that's the definition of hardcore stock. Then there is the core stock. So after the core stocks, after the hardcore, there are core stocks, meaning there are some stocks in each indices. So Nasdaq stock, Dow Jones stocks, S&P stocks, some Russell stocks. So I put them in the core stock, even though if I don't trade, but they are in my list. Sometimes I find the candidates. And then there are non-core stocks, I call them. Those comprise of S&P 500 and Nasdaq 100 and Dow Jones 30. So I put them all. I don't trade AT&T or Verizon or things like that. A small, dividend stock I don't trade. So, but I need to see them during the market hours because I need to understand where the market is. So sometimes, so the in the market analysis, so I do the market analysis every day. So in the market analysis, you need to do the top down. I do the analysis in two ways. One is a top down analysis, and another one is a bottom up. So top down analysis I do, so it's done every day, 5 times a week. Top-down analysis where analyzing all the indices to see where they are, or analyzing all the ETFs related to those indices, and then analyzing the future market related to those indices. And so that is the top-down. Now the bottom-up approach I do is analyze the individual stocks and see where they are. So a lot of the stocks, when they are overbought, and the market is also saying overbought level, then I understand that the market may uh, stop going. Maybe there is a short-term reversal coming. So that's the theory behind watching the non-core stock. A small cap stock, so a small cap stock like Riot, Mara, and others, when the market is bullish, like right now, so the small cap stocks are moving. They move fast, 25%, 50% gains. So I make a list of those fundamentally strong stocks. So I don't want to buy small cap stocks which are technically weak, fundamentally weak, and I just buy them and lose 25, 50%. So I don't want to do that and get stuck forever. So it's like, oh my God, now I'm there and I got married. Now I cannot divorce. And I'm married for this in this small cap stock forever, and I will pass this stock to my grandkids. So I don't want to do that. I have such one stock. So it's some coffee stock I bought a long time ago, like 8, 9 years ago. I bought it for 10 cents or something like that. 20 cents, somebody said, those pump and dump newsletters. So 10, 20 cents I bought, and it went to 80 cents. So suddenly I saw 80 cents. I said, okay, now it's 80 cents. And the guy is promoting saying it's going to $12 or whatever. It went to 0 cents. So right now it's just 0 cents. So I don't think so my investment is gone. In other words, that is small cap stocks I bought 8, 9 years ago on some pump and dump. So a small cap stock, you have to be careful. So a small portfolio of your uh, small percentage of your portfolio should be dedicated to small cap. So just allocate a small percentage of your capital, like 10, 20% of your portfolio to a small cap. So that is a small cap list, and I keep adding. So when the market is moving up, bullish strength is good. A lot of small cap stocks get added into the list. When the number of small cap stocks going down, I know that okay, yeah, the Russell is weak and the market is weak. So the number of stocks I'm watching on a small cap, they go down. I have a service called Tiny Stock Trading. So you can look on the website tradegenie.com. There is a tiny stock service. I provide that services. Sometimes I trade options also. So options, not all the time, but sometimes I trade options on a small cap. Mostly I'm trading option on a hardcore because these are the stocks which are moving. So the movers of the market. Then I watch indices for all indices ETFs. So I have indices ETF, all the gold ETFs and silver ETF, etc. Semiconductor ETF, then the gold and silver stock also. So when the gold and silver stock moving, then I have a list like 8, 10 stocks. So I buy those, um, not all the gold and silver stock. Then there's an inverse ETF. So inverse ETFs are those ETF which move against the market direction. So if you have a trading system where you are only comfortable in going long, then you during the market downtrend you can trade inverse ETF because they will be moving up. So it's easier for you. Some people cannot just trade in the opposite direction. So for them, it's good. Just build the list of the inverse ETF and apply your trading system, which is meant for long. So when the market is going down, these inverse ETFs are moving. And sometimes it gives you also the clue to the market reversal. So um, one of the market reaches a certain key level before the other markets reach. And sometimes the ETF gives you the clue. So if you're watching inverse ETF or the ETF, then besides the market, then it can give you the clue that out of the four major markets, this market has reached, let's say, the oversold, overbought level or some key resistance level. So it gives you the clue. So extra, it's like bonus. You're reading the market ahead of something you expect, and you are reading it correctly. So that is the objective of inverse ETF. Another thing which I learned from the very beginning that there are thousands of key patterns. There are thousands of chart patterns. I cannot master all the chart patterns, and the reason is that I cannot master some chart pattern. They appear only once in a lifetime, so I just cannot. Even though they are profitable, I cannot. I should not be mastering that kind of a pattern which appears once in a lifetime and is very profitable, and I'm just waiting for it. And it so happened when it appeared, I was sleeping or I was not watching, and it so happened that I entered in that trade. I saw it, but this time it was a failure. So don't need to master those techniques or those patterns. So don't need to waste the time. Look for the things which are repeatable. They repeat. They appear often. They are reliable. They have certain profit percent, the reward. So something which appears again and again. You don't want to master something which is like once in a lifetime kind of thing. So once we master the techniques, then we apply it to the basket of stocks. So think about it. You master certain things and then you apply to the basket of stocks. So I mastered uh, the key patterns or key techniques and then apply it to the hardcore stocks. So there are only 200 stocks. So out of 200 stocks, something is moving up and down. So something is moving up and down out of those 200 stocks, and I am looking for something which I know that I have seen it before. I can recognize it, looks familiar to me, and then when I see it, I feel good. So when I see it, I feel good. So that's the key. When you see it, you feel good. If you feel good when you see it, that's the trade you can take. If you so internal signal, you need to have some kind of an internal signal, not just external signal. Internal signal which is coming from your body. So you see it, you get you don't get excited. If you get excited, then you may lose money. Just a second. Uh, okay. Yeah. So these are the advanced trading. These are the trading strategies. You can call it advanced, or it's just. It used to be advanced for me when I was starting, but it's not advanced anymore because you keep doing it and then it becomes second nature. So, but I wrote it down: advanced trading strategy, techniques and patterns. So these are the 12. So I will explain to you in few slides each of them what I do. So sometimes I'm doing this, sometimes I'm doing that. So it depends on what is happening. So I'm applying it. So there is something called black box trading strategy. So you buy a black box, kala dabba, you know. Kala dabba means black box. So you just buy a black box and you just follow the black box. It tells you to jump, you jump. It tells you to sit, you sit. So it's like that. And so it tells you, it puts some green arrow, red arrow, and it says, okay, buy here, and you buy. You say, it says sell here, and you sell. So you just blindly following that black box. So there is a black box trading strategy, and I'll explain. Chart pattern trading strategy. So you master some charts or many and trade that. Band trading strategy. Then there is a trend trading strategy. Then there is a moving averages breakout strategy. Then there is a support and resistance trading strategies. Then there is a breakout strategy. Then there's a breakdown strategy. There's a gap up strategy. There's a gap down strategy. And then there is a gap reversal strategy. And then there is an intraday reversal strategy. So many strategies. So I apply almost all of them. So I'll explain to you little bit of everything. So that's the purpose. And then I will explain to you if I reach that point, how I send you the trade alert and the targets, etc., and what you are supposed to do when the trade is moving, going through its journey. So what is black box trading? So black box trading is algorithmic trading or automated trading. So it's just a black box. It's a black box. Somebody programmed it. So it's his belief. So he believed in something and he programmed it. And so that program turns out to trade, and you get some kind of signal. And then you just, with that black box, you link it to your broker, and the black box is telling you to go long. Since you have linked it to your broker, you just execute the trade based on your position, based on your portfolio size, based on your risk profile, and what kind of a time frame you are looking at, what is your style, what the black box is telling you to do. So that is the purpose of the black box. It's automated trading. So executing trade without human intervention. So it's basically almost no human intervention. So you don't have any input into it. You're blindly following it and you trust this black box. And this black box has some predefined criteria. So whether you know that criteria or you don't know the criteria, so most of the time you don't know what's the logic. You just believe in that logic. You believe in that person's whatever he believes about the trading, about the market, and you trust that black box and you're trading. So there could be a complex mathematical model behind it. They have done it by reading the historical data. The black box analyze vast amounts of data. So you need to have a very powerful computer, very reliable internet. The black box is downtime is almost like zero. And what the black box is doing is analyzing the prices, volumes, and they have built some indicators, and they are giving you, they may be reading some chart patterns. So chart patterns can be programmed. So all these chart patterns we hear, double top, triple top, and multiple tops, and head and shoulders, all that. They have programmed it, and now they're telling you, okay, this is a chart pattern, and the volume is good, the price is good, and and the long signal. So whatever is your time frame on that, it depends if you're a swing trader or a position trader or an intraday trader. So that black box is giving you the signal, and you have linked that black box to your trading system, your broker. Maybe it's inside that black box, so the broker has given you that black box, or it's some third party, and you linked it to your brokerage platform, and you give this black box to your nephew and say, hey nephew, trade this black box for me, and I give you 10% cut. And then tomorrow you come back, or after a week, your nephew has wiped out your account. So you say, okay, uncle, you told me to do this, and I wiped out, zero. So it can happen. So this is black box. So you have to be really know what you're doing with the black box. So black box have a lot of data they have collected, maybe 100 years of data they have, and they have every second the data is getting analyzed. They have developed a lot of strategy behind. So there are strategies there. They have done some back testing, and the back testing could have been done in an environment which was working at that time. So when they say that the black box, this our system produced 99% winners, 99.99%, and on average the trade made 2.6% gain. So they're just telling you this 99.99% win rate, and the average gain is 2.9%. So that's the black box advertisement going on. So then you ask, okay, what about that 0.01% trade? That was a big loser. And for 99.99% win rate, I have to be like super human or robot to trade all that trade. And for the black box, because the black box was tested in a certain market environment, so they took a certain period of, let's say 2023, they took the certain period, that 15-day, which was very conducive to the strategy they developed, and apply their black box into that period. And that, because they applied into that period, and it tells them 99.99% win rate. So be careful about that. You need to know which period and what how it was tested. And execution, so it's like flawless execution. You have to be a real robot. Then you executed everything. There's no slippage, not even 1 cent. So 99.99% win, with no slippage, nothing. And maybe there was no commission, brokerage commission, etc. So ask yourself about the black box trading. Advantages of black box trading is speed and efficiency. So it's a speed and efficiency. You don't have to be involved. You're just trading. Maybe you're a high frequency trader. Maybe you're a day trader. And it's emotion-free trading. So it's emotion-free trading. There's no human involvement. If it says exit, you exit. You says buy, you buy. So um, you can buy 100 shares. You can buy 1 million shares. It's up to you. So the same black box, you can buy 10,000 shares. You can buy 100 shares. So if your black box is working and it's consistent, then all you need to do, if the black box is really a magical box and it's consistently producing the result, then instead of buying 100 shares, then you start buying 2,000 shares. So your profit again go up, and then you don't have any emotion. You can walk your dog, you can make coffee, and the black box is working. So that's the advantages of black box trading. So now the limitations of black box. So data dependence. So data, the quality and availability of data. So not all the data coming in could be could be the right data. The market data could not be, maybe it's not right. Maybe there is some flaw in it or some misprint. And the availability of data. So who is providing the data? Where are you getting that data into your black box? Now, the black box, the market conditions may change immediate on you, like within, like you're trading and you got the signal, and then certain thing happen in the market, and it just fails to adapt to that certain changes in market. So all your position go into loss, and you don't have any control. All your position turn into red, and it exits. So you suffer a big loss, and after a few minutes, you see the market reverse on you and everything turned green. So that's the disadvantage, limitations of a black box. It may not adopt or see the market conditions. It may act, and then the market was just, condition was just temporary. So think about that. Systemic risks, widespread use of similar algorithm. So if everybody is using that black box, then you don't have any edge. So in trading, if you don't have any edge over other traders, uh, your your performance will go down eventually. So everybody gets that black box. Everybody is using the same algorithm. So it will stop working. So think about that. The black box will stop working any day. Now there is another technique called chart patterns. So that was about black box. Now this is a chart pattern. So chart pattern is unlocking price trend for strategic trading. So chart pattern is a visual representation of historic price movement. So you're looking at the chart, there are a lot of bars, a lot of candlesticks printed there. You're looking at the daily chart, let's say. You're looking at, for example, let's say Apple. So Apple chart, you can, if you can read the chart properly, which is visual, so visual, based on the historical price movement, maybe you can come up and it gives you the insight into potential future price trend. So you see Apple and all the historical data, let's say last 9 months, and Apple is moving today and it's crossing 194, and then you say, okay, it's crossing 194, it was a resistance, now it's going to 194, I expect it will go to 198, 200 level. So you can project the future price trend, and so you can identify the entry and exits. Just a second, let me do you know your list of stocks under each list? Yes, I know the stock under each list. Yes, of course, Anthony, I know the stocks under each list, of course. So I know all the stocks under my each list. So okay, so identify entry and exit points. So by reading the historical price movements, you're expert in reading the historical price movements. You're projecting the future price trends. So identifying the entry and exit points. So entry is 194, your exit is 198, and you exit. So that is a chart pattern. So it's a uh, complex process to identify all the chart patterns correctly and read. So that's what I do during the day. So some of the common chart patterns. So now there are hundreds and hundreds of chart patterns. So you don't need to master all, um, just few listed here. So head and shoulder patterns, where there's one head and two shoulders. And when the neckline is broken, the support is broken, maybe the neckline tested, and then you get in to the short side, and then you measure the distance, etc. So that is head and shoulder pattern. There's another one, double top and triple top. So market test 2 times this resistance. So maybe double top is not reliable as compared to triple top. Maybe there's a multiple top. So all that, you're using it, double top and triple top, and combining it. Not only, so these can be, there's something called a Western analysis, and then there's something called um, Japanese. So you can combine the Western way of analyzing the stock and with the Japanese way of analyzing it. So Japanese and Western combined together, you get some edge over other traders who are just looking at the Japanese or just looking at the Western. You need to look at both. So double and triple top. double and triple bottom, same phenomena. So multiple bottom or multiple top. Then there are the other chart pattern, ascending and descending triangles, cup and handles, the wedges, the flags. So there you can list, there are hundreds of them. So you try to master all of them, or you say, okay, no, I'm not going to master all of them. I'm only looking for a few, and I master it, and then I combine it with the candlesticks. So I combine it with the candlesticks. So when the double or triple top is occurring, I need to take help from maybe some candles. So candle may tell me the story. I may take help with the volume. I can apply the trend line techniques when the double or triple top is occurring. So I'm applying different multiple techniques. I'm applying the candlestick pattern. I'm reading the volume. I'm applying the trend line break. So there are many combinations of things you apply one over the other. So multiple confirmation. So you're getting not just one evidence, you're collecting multiple evidence. So just one evidence is not enough. You need to present multiple witnesses. So it's like not one witness is not enough. You need at least three to win your case. So three witnesses. So triple top is there, the candlestick is there. I know this is the weights, and then I identify the key resistance level. This is the key resistance, and the volume is this, trend line is this, and then I get in the short position. So that is some of the chart pattern. So I do all that. So application of chart pattern. So identify the trend and confirm the signal strength. So you need some kind of evidence that is giving you the confirmation of your signal strength. So not only um, just look at it and jump. You need to have some kind. So not all double top and triple top means the market will reverse. So the double top and triple top, they do get conquered and the market goes to the moon. And then you wonder, I bought puts. Like I see traders, they just go and buy the puts when a double top is happening. So I mean, a double top is just a double top. Market will break. Triple top means just a triple top, and the market may break and go to the next level. So you need some kind of a signal strength confirmation, and then some way of identifying the price targets. So when the double top occurred, or multiple top, or triple top, and you went short, then where are the price targets? Where would you exit? What would tell you that now the game is over? And do you have enough potential in the trade? If you don't have a potential in the trade, there's a triple top there, and just below triple top levels, like 3 points below, is the strong support. So that triple top, unless I'm trading very quickly and I'm very efficient in exiting and entering and exit, uh, 3 point is not enough. So the where is, if you fall, where would if the stock fall, where it will fall, in other words. So if you're climbing the mountain, if you fall, will you just break your leg, or you're gonna die, something like that. So set price targets properly. And then when you double top, if you enter in the double top or triple top, what would tell you that that triple top is your signal was not right, and it's a failed trade, and now you need to reverse your position. So instead of just holding the short position at a loss, you reverse it and go long. So what would tell you that this triple top was not right? You failed. It was just a false signal, and actually it's a long trade. So false signal can appear. So subjectivity is there, and a lot of market noise. So when the tops are occurring, everybody know about the triple top, or everybody knows. So if you think you're smart, you're thinking, oh, this is a triple top. I see it. So no, there are other millions of traders. They are also seeing it, and they are a lot smarter than you and me. So so the market may temporarily stop at triple top or double top. So for example, I give you Apple. So Apple have a very strong resistance at 194, and then it created another resistance at 198.23. So Apple to me uh, has reached its limit. So there's a limit. So Apple has reached its limit of 198. Now the earning is coming up. So what I'm going to do, I recently I traded puts. I'm going to wait for Apple to move up, and then I will take a flyer on Apple puts. So and see what happens. So not just a short term um, trade on Apple. So so when the triple top is happening or multiple top is happening, it seems like okay, market is facing this resistance and it's gonna crash. No, it depends on a lot of other traders out there. They have a different opinion about that trade. Some traders are thinking, okay, Apple is going to $4 trillion. So I ask, hey, 4 trillion? Okay, how about 5 trillion? Where did you plug this number 4 trillion out of thin air? What is it called? Poof, like poof it. So why not 5 trillion? I mean, if you're talking about 4 trillion, let's talk about 5 trillion. So you see the traders have the valuation for the Apple 4 trillion. So, and then you are saying, no, Apple has topped out and it will go down. So I'm buying puts. So different traders, different opinion. Now there's another trading strategy called band trading strategy. So it embrace volatility. So you need to apply in a band trading. So in the band trading, let's say the Bollinger Band, etc., or there are other bands, the market is getting you're expecting the market to be volatile, so you're using the volatility indicator and you expect the market to break through one either the upper range of the band or the lower range of the band. So you're identifying the price ranges and then you're exploiting the market fluctuation within the band, and then you're expecting the market to break through either to the upside or to the downside. So you're capitalizing on a short-term price movements by trading the band. So traders do band trading, and traders are expert in it. So if that's your thing, you master the band trading. You identify the upper and lower price levels. You create the band or channel. So you create a band or channel, and then when the market break the upper level or the lower level, you're either exiting the trade because you entered in the band in the middle, and then when the market breaks the band to the upside, there's extreme level, so the volatility expanded, and then you say, okay, this is the profit I was expecting, and you captured it. Or the market reached the upper level of the band and you say, okay, this is enough, I'm gonna take my profit. Or the market is exploding above the upper level of band, so it's expanding, the band is expanding, and then you're adding more to your existing position. So different traders, different strategy for trading bands. So executing buy and sell orders at band price level. So there's an upper level and there is a lower level. So this can be another strategy. So there are many kinds of bands. If you Google, if you buy books, or you take help from someone, enroll in classes, the Bollinger Bands. So Bollinger Band uses standard deviation. So you need to understand what is the standard deviation. Dunchin Channels identify highest high and lowest low. So understand the concept of highest high and lowest low. Keltner Channels, they use average true range. So you can use any of these band and see which one fits your style. So not everything fits with everybody. So you find your own unique style and trade accordingly. All right. So application and volatile identify. So band in you need to identify the overbought and oversold conditions. Band also act as a dynamic support and resistance level. So band levels, the upper level and the lower level, act as a support and resistance level, and you capture the breakout. So if the price breaks the above price level of the band, you're going for that breakout. You may be setting the band price levels as your stop level. So if the market breaks, let's say if you went into the long trade while the market was fluctuating in the band, and your stop level is set at the lower price level of the band, if it violates the lower level of the band, you say, okay, that is my stop, and you exit from your trade. So band trading, upper level, lower level, a breakout, breakdown, etc. Keltner channel, Dunchin channel, Bollinger Band. So it depends which kind of a band trading you're using. Now there's a limitation. So false breakout. So market can break above the band level, and you think it's if you anticipating it's a true breakout, and the market is has broken the upper level of the band, and you're entering it, and then you next day the market just drops um, back into the band, and then it just keeps going down. So you can get whipsaw. So you need to apply other techniques while you're using the band. So whipsawing, price movement within the bands, frequent trade signals. So the market can move up and down, up and down. You can put some moving averages like 20-day moving average and take help of the moving average, and you're getting whipsaw. So understand the limitations of the band trading. Adapting to market condition, adjust band parameter to suit changing market conditions. So you may be able to change the band parameter. So the band, whatever is the parameter set for the band, you may have to change the parameter. So if you're changing it quite frequently, then it's not, you're just suiting you're putting the data to suit your needs. So that is not a true trading. You're just changing the parameter. Okay, let me see if it's a 21-day moving average will fit, and then it fits. Okay, you say, okay, 20-day moving average is not good. I'll try 21-day, and then the 21-day doesn't work, and then you check and you say, oh, I set it for simple moving average. No, 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 not simple moving. It needs to be exponential. Your buddy tells you, hey, why don't you try exponential? So you just change the exponential moving average. And then you say, no, it's not working 21 day. I will try 32 days simple moving average. So if you're doing all that, something is wrong with your trading. So there's another strategy. You may master trend trading strategy. So in the trend trading strategy, you're riding the market momentum. So in the trend, sustained price movement. So once the trend is established, provided you are not too late in the identifying the trend, most of the traders, they are late in identifying the trend. They don't understand. They are unable to detect the change in the trend in the early stage. So basically, the trend trading is you expect the price to sustain in that direction of the trend. So if the market is making a new high after new high, you expect the market to continue going higher. You don't have any reason to say the market will reverse. Why would you think if the market is going up, why you think the market will go down? Unless you have some other reason, and it's a valid reason. So you can combine the technical indicators. So if you have some technical indicators which tells you the strength of the trend and confirm your reading, then ride the trend and stay in the trend as long as the trend is there. However, what happened, traders fail to recognize when the trend changes in the early stage. They are late in detecting the change in the trend. So they're late in detecting the change in the trend, and then a lot of traders, they give back all their profit because they still believe the trend is there, whereas the trend has changed 5 days ago, and now is all downhill. So some way of protecting your profit when you're riding the trend. So some way of stair step, maybe you add, so you have a strategy of scaling in. So stair step, when the market moves up a certain step. So it's like you climbing the mountain and they have built you the step, like grandpa built the step for me, but he put some slab, so you cannot just keep going up and up and up, so you take some rest. So you climb 50 stairs, it's steep, and then you rest, and then you protect yourself, and you say, okay, now I'm done, I'm rested, now I go to another 50 step. So when you reach that level, you protect yourself, and then you go for another 50 step. So you raise your stop loss level, and then you add more to your position. So some way of adding more to your position and riding it. And then so if you lose, you're losing only the last unit, and the second last unit maybe turn out to be a break even, and all the other units you bought below is all in profit. So you bought 100 shares, then you bought 50 shares, then you bought 25 shares, then you bought 12 shares, so you bought 12, so you bought like that. So you're protecting it. So 100 shares, then 50 shares, then 25 shares, then 12 shares. And then when you see the change in the trend, so basically your 12 shares which you bought, the last one is the one which is losing money, and maybe you come out break even at the shares you bought, 25 shares, and the rest of the 150 shares are in profit. So that's the concept of trend trading. So you can use moving averages to identify trends. So moving averages for entry and exit. So if you can take help of the moving averages such as 50-day, 20-day, or a 10-day exponential moving average, or a 200-day moving average, some moving average crossover, some moving average bounce. So the trend is there, and then you're looking for entry, and you rely on your moving average. So the market moves back to that moving average, and then it bounces up, and you go long or short, whatever it is you're looking at. You may take trend lines, so draw the trend line to visualize the direction of price movement. Now, in order to draw the trend line, you need to have some kind of a points to connect. So same chart, if we all draw the trend line, we will draw differently. So one trader will take this low and then extend to the all the way to the upside. Another trader will take another low and then he will draw the line. So if you see that, there will be multiple trend lines. So you have to know the trend line is there. So it's just a line. So it's just a line where the market is, most of the time maybe is correct. So if you are expert in drawing the trend line, you say, okay, no, I draw the trend based on the higher high and higher lows, and I use higher time frames such as weekly or a daily, and it's correct. So I draw the trend line, and when the market bounces to the pull back to the trend line, and it has held the trend like 6 times before, so why do I have to doubt the 7th time? So when the 7th time the market bounced back to the trend line, I go long. And then you just need to know that what will tell you that this is not the same. The 7th time was the wrong time. You are late. In the 7th time, it broke. So when it breaks, you have some way of knowing that, okay, this time the trend has broken and now I need to close my position. There's something called Fibonacci fan line. So you can use the Fibonacci ratio to draw the trend line. So for, you can different methods of drawing the trend line. So there's a Fibonacci fan line. You can use a parabolic SAR, which is trailing stop and reverse indicator. So you can use you can protect your profit and you can follow the trend by using the parabolic SAR indicator. So this is another way of using the trend line. Application of trend identification. So identify uptrend and downtrend. So basically we are identifying whether the trend is there and we are not late in the trend. We have the expertise to identify the trend early on. We can use the moving averages. And when the trend line gets violated, there's a breach, then I need to exit. So if I'm in a trend and I follow that trend line to enter, when there is a breach, I need to exit from the trade. And I may have to, so I exit from the trade because the trend line has breached, but I'm not overreacting because a lot of time when the trend line is broken and the market just bounces back above the trend and then it continues to move up. So be careful, have some kind of another secondary confirmation. So some kind of a secondary confirmation you need to have, maybe moving average crossover or other techniques where you say, okay, this trend line is broken and it's a valid break, or this trend line is broken, but it's a temporary. So maybe you can apply some techniques of how many days you need to wait when the trend line is broken. Is it 1 day, 2 day, 3 day? Well, you can apply the techniques of percentage that market needs to break this percentage, 1%, 2%, depending on your time frame, that this percentage is broken. Now I need to exit. Or maybe the dollar point, say, okay, the market has broken these many dollar points and I need to exit depending on the market average true range. So depending on the market volatility. So you need to apply certain technique. Maybe so the trend line, maybe you can apply the techniques of the horizontal support and resistance. So the trend line is a line, upward sloping or downward sloping, something like that. whereas the support and resistance is a horizontal line. So maybe you can create a channel of a horizontal in a certain price zone, saying, okay, the trend line is there and below is a support, a strong support zone. It's like a channel, it's like a little river. So it's not a wide river. If it's a wide river, then your loss is more, because you have to, as long as the stock is trading in that wide river channel, you shouldn't be exiting. So it's a narrow and it's very strong, and it's below the trend line. Let's say you're watching the long position. So you are in the long position. So the trend line is broken, but it fell in the river, is in channel. So you still are okay to hold that position. So some kind of a techniques, number of days, percentage, the dollar, the support and resistance. So apply the support and resistance techniques at that time and see if it merits to hold that position. Some kind of a moving average crossover. So use that, some kind of trailing stop to protect profits and stay in the trend. So if the stock is wild, like Tesla or something like that, and you're riding it after a certain profit, you can put the trailing stop. And make sure you put the trailing stop not too tight that is useless. So a lot of traders, they use the trailing. I'm gonna set the trailing stop. Oh, I'm out. So don't use the trailing stop with the tight trailing. Have some leeway, some percentage of average true range, so give the room for that stock to move. Because if you just put the trailing stock and it's very tight, you might as well just exit from the trade. Just say, okay, bye bye, I'm exiting. So don't use the trailing stop which is tight, and especially if you're trading options. So I don't use the trailing stop in the option. It doesn't make sense to me. So trailing stop can be used to protect profit and you stay in the trend. So some kind of, when you're trading the trend, some kind of a strong support and resistance there, moving average crossover there, some criteria of uh, dollar fixed dollar amount, or a percentage, or number of days, maybe combination that 3 days have gone and the stock has not bounced above the trend line. It has gone 2% below the trend line price, and I have a better opportunity, etc. So I exit. So have some kind of a exit criteria. So false signal, sideways trend don't work. So trend means the trend. So if the market is choppy or sideways, the trend trading, it doesn't work. So false signals and sudden market reversal. So you expect the market is trend trading, but it's whipsawing because the overall market is false. So it's weak or choppy. So it's giving you up and down signals. So frequent trade, exit. You're going up, you're entering and you're exiting, entering and exiting. So it's not good. Um, the trend trading, if you can identify the timely exits, either it's a predetermined exit. So if especially if it's a option trading. In option trading, you see 60% profit today, tomorrow you see 10%, and the day after tomorrow you see 30% negative, and then fourth day you see 100% profit. So if you can hold all this you know up and down, like a what you call the ride, up and down, oh, ooh, going up, down, 40% up, now it's 30% down, etc. So if you do that in option, it will make you sick. Whereas in the share, because there is no time decay, so it works, that. So apply the trend trading, but know your limit. So know your limit, and you're exiting it um, at the right time. So identify the key level to exit before the trend changes on you, and you give back all your profit in option. So identify trend reversal promptly. So be on the lookout. So have some kind of a way of identifying that the trend is changing. Maybe take help with the chart pattern and candlesticks. So a lot of time the candlestick, the tiny candles like doji or engulfing, etc., they give you the signals that the market, the trend is changing. So certain candlesticks forming at a certain price level. So certain candlestick, they form at a certain price level, they give you the clue that the reversal is happening. So master those candlesticks, which tells you about the reversal, whether to the upside or whether to the downside. So do that. So I do. Now, another kind of trading is support and resistance trading. So support and resistance trading is very important. So knowing the support and resistance is very, very important, because support and resistance is where the battle has been fought. So if you don't know where the battle has been fought, you will get caught in the same, it's like you arrive at 8 o'clock at night time, the roads are closed and the snow is falling and there's a snowstorm, and you're the only one stuck in Mammoth Mountain or Yosemite, and all the exits are closed. So you're there. So if you don't know beforehand, you will be stuck and probably die. So support and resistance act like that. The battle has been fought before, and the battle will be fought again. So when you're approaching that price level, know beforehand that this is the price level I'm approaching, and the market can reverse or stall. So when the market can reverse or stall, what are you going to do about it? If you have a position in it, will you exit? Or if you're looking to add to the position, or you're initiating a new position. So identifying support and resistance, and not only identifying support or resistance, but how strong it is, when it was formed, how many time it tested, all that you need to understand about support and resistance, because support and resistance are the psychological barriers. So um, it's millions of traders um, fought that battle. So you live or die. Yes, John, you live or die. So psychological barriers. So they are market participants. So knowing, understanding the market participant, who are the market participants who are creating the support and resistance level. So the market participants are the one who are long in the position. The market participants are those who are short in the position, and then there are participants who are neutral. So they are waiting for that barrier to cross, and then they will join the forces. It's like, okay, you guys fight and then let's see who wins, and then when you win, let me know and I will join that side. So it's like that. So there are so think about it, there are psychological barriers. So some traders are winning, some are losing, some are on the side, and those who are losing, they close out their position and they join. If they are smart, they join the winning side. They say, okay, I'm going to join this side because that side is winning. So support and resistance is very important. So anytime we enter in the trade, we take help. Anytime we enter in a trade, we need to know where we will exit. So in one of the movie, the Robert De Niro is set in some European country. So he is entering in a building. He has like 5 buddies, and he's going to meet the other guy, the gang leader. So he disappears and he comes back after 10 minutes. So his friend asked him, hey, boss, where did you go 10 minutes? So he said, never enter a building without knowing where to jump, from which window you will be jumping out. So never enter and trade before knowing where is your exit. So support and resistance is the key for knowing where you will be exiting at loss. So where you will be exiting at loss. So if you know where you will be exiting at loss, the logical level is to go as close to the level where you will be exiting. So if I'm entering in a building and I don't know what is inside the building, and the other guy is telling me, come and meet me at the 12th level floor. So I will say, damn, 12th floor. If I jump from there, I'm not going to survive anyway. So I rather have a meeting maximum on the first floor. So if I jump, I just break my bones or my leg and I will survive, but not the 12th floor. No, no. So maybe on the ground floor or near the window. So the support is like that. So know where the support is. So if you're wrong, you exit. And understand the support level and the key resistance level are formed by the market participant. The battle has been fought and history has been created there, and a lot of traders have fought that battle and died over there, and traders have won. So knowing this, then it's very important for us to know where the support and resistance is. So be very, very adamant in understanding support and resistance level. You tell yourself, you remind yourself, okay, I'm not going to trade, I cannot start my trading career without understanding where the support and resistance levels are, and I should be able to take action. So what is the support level? where the buying interest is strong enough, and it prevents further price declines. So if you are in the trade and it's going against you, it will create like a peace to your mind, some calm, some patience. If you know this is the support level and I am holding fire. So in one of the movie, Mel Gibson tells, Braveheart or something like that, hold, 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 and then he says fire. So when the market is reversing sharply against you, if you know the support level, you will be not only you will hold that trade, but you will add more to it because you have some dry powder. Resistance level is the selling pressure prevents further rise. So resistance level is where everybody wants to sell. Whether they bought at that level 50 years ago, now the price is reaching that level and they are selling, they are willing to get out at break even. So if the buying interest is more, then that resistance level is temporary and it will, the market will break the resistance level. If the sellers are more than the buyer, then the resistance level will hold and the market will crash. So when the market is reaching the resistance level, we don't try to be a hero and say, okay, at this time the market will break the resistance level and I will make a lot of money. No, before the resistance level reaches, you need to exit and see where the market goes and see the test of that resistance level and then enter a brand new position, because that resistance level will turn into the support level. When the resistance is broken and it holds from the top, then that becomes a support level. Then you know, okay, this has turned into support level. So for example, give you Apple. So I say Apple, okay, no, I'm not going to go long on Apple at 194, 198, because I know 198 to 200 is a very strong resistance. So I will not buy Apple here. I will rather look for the position to liquidate, and I'll wait and see. I will not get into temptation that Apple is looking strong and is going to 4 trillion. So once 198 or 200 is tested and Apple hold, or it drops significantly like 185 or 175, then there's another story. So think about that. So support and resistance level is created by the collective actions of market participants. And then there are millions of market participants. There are millions and trillions of dollars. So think about it. If Apple is a $3 trillion stock, then there are $3 trillion invested in Apple. So collective actions of market participants. So now there are various ways of identifying support and resistance. So just it's very hard, support and resistance, but at least you can try. This is the starting point for identifying support and resistance. Learn to identify swing highs and lows. So see the swing highs and lows, where the market goes up, then come down, and then goes up, then come down, then goes up. So start reading that highs and lows, not only on the daily chart, but look at the weekly chart, look at the intraday chart, hourly chart, 2-hour chart, and see where the highs and lows are being made, and start drawing the line on your chart and see if that these levels are hold. There are some psychological levels like big numbers, 100, 200, 500, 1000, 2500. So one of the numbers listed here, 200 for Apple. So 200 Apple. So some psychological levels are there, and the market do react. I remember Amazon when reaching 1000 or something like that. I have seen all these numbers and they react. So these are very important numbers which I listed. These are big barriers, and it creates, don't go long unless you have a very solid reason and you see a volume and a cannonball is fired and the market breaks these big numbers. So a cannonball is fired. So think about it, these numbers are like China walls. So if you are Genghis Khan and you bring tennis balls to break the China wall, you will not. The Chinese will crush you. So you don't want to bring a tennis ball to the wall. You will bring cannonballs to break the China wall. So these numbers act like a China wall. So you need to bring some cannon, big cannon to fire, and not one time, not two time, but multiple time. And eventually, if the levels are broken, then you know that okay, now the market has conquered this level, and I am willing to go long. there are other techniques for support and resistance is the moving averages, which is everybody know about the moving average. So what everybody know the moving average is a 20-day moving average, a 50-day moving average, and a 200-day moving average. So everybody know these moving averages. So psychologically they act as a support and resistance, and they talk on CNBC. The market is reaching 200-day moving average. I'm gonna buy some here. So they don't tell you that they have been buying it and they have a big losing position, and they just say, it looks interesting over here, so I'm going to buy some right here at 200-day moving average. And then when it breaks 200-day moving average, then you say, okay, I apply 205-day moving average. Is it a simple moving average or is it an exponential moving average? So all that, but it's a natural, and the market do act as a support when it's dropping, they act as support, and when the market is moving up, it acts as a resistance. And sometimes you can apply the moving average crossover. So the 20-day moving average is crossing above the 50-day moving average, so it's a signal. Or the market is trading between 50-day and 200-day moving average, so it's in la la land, and I'm not going to touch this. When the stock is in the la la land, I need the stock to move at least above the 50-day. So by the time you enter in the above the 50-day moving average, the market is too late. It's already time to crash. So, but do apply these and see what do you see to identify the support and resistance. So application of support and resistance. So the support and resistance act as the entry and exit points. So this is so true. So support and resistance, provided you have identified the support and resistance correctly. So what you are, so again, it's your belief. So you are applying your belief that this is the support and I must enter here. But that's your belief. It's not the market belief. So if you're wrong in your belief, you lose. And if you believe that this is a resistance level and I exit, and if the market doesn't think like you thinking, then you are wrong. The market keeps going and breaks through the resistance. But overall, you're better off in understanding the support and resistance and time it, your entry and exit, or and adding more to the position, or setting the stop loss levels. And then and when the market is approaching the support and resistance level, then gosh, the market sentiment. So what else is going on at that support and resistance level when the market is approaching that support and resistance? Flip your chart to the intraday level and see what you are thinking that the market will do at this support and resistance. So if you're looking at the day chart, you're not going to see anything. You need to go deep dive and remind yourself that, hey, the market is going to the support level. I have a position, and now I better look at the intraday chart. So go down to the 15-minute chart or 30-minute chart or a 5-minute chart and see what you are seeing and want to see. But what you want to see, the market will show you at that moment or during that day, and then it will continue to fall, because what you're trying to see is other markets participant also thinking the same way. So temper is a temporary stop, pit stop, and then the market continues downfall. So you when you are trying to see something, make sure that that is right, because what you're trying to see is others are also seeing it, and uh, maybe they are also wrong. But most of the time, there's something called the crowd, the law of the crowd, or the crowd wisdom. So most of the time, the crowd is right. So if you go against the crowd, you may lose. So support and resistance, and so there are limitations. So false breakout. So sometimes or a lot of time the support is broken. So there's a story I read in one of the books. There was an old man, a broker in the New York Stock Exchange. He had a seat and he hired a assistant. So he sent his boy, this boy, and said, "Okay, boy, you go and trade, buy for me and sell." So, and this old man is sitting in his chair up in his office. And then he came down and he asked the boy, "Okay, boy, what are you doing?" And he said, "Sir, I'm buying when the stock, you see, when the stock goes down to this level, I buy. And when it goes down, goes up to this level, I sell, and I'm making money." So he said, "Really? So is this what you're doing?" He said, "Yes, I'm doing this." He said, "Okay, so when the market pulls back to the support level," so the old man asked, the boy, okay, so what are you going to do? So the boy said, okay, it came down to the support level. Now I'm going to buy. So he said, okay, sell 100,000 shares on my behalf right now. So he ordered his boy to that assistant, the grasshopper, sell 100,000 shares. So he had to sell, and the market crashed. So the thing is, you never know at what price level, when the support is there, who is getting liquidated, who is getting the margin call, who has other uh, opinion about the market. So the market can break those support levels, or the market can go above the resistance level. So be careful. In order to understand your support and resistance level, apply the multiple time frame analysis. So apply, always have a multiple time frame. So you need to have a monthly, weekly, and a daily time frame chart. And then you have another workspace with the daily, 4 hour, 2 hour, etc. Then you have a third one which starts from the hourly and then go down all the way to the 5 minute time frame. So when you're evaluating support and resistance, apply the multiple time frame analysis. See if you can read it correctly by applying it, because what you're thinking the market will do at that support level or at resistance level, it would show you on a multiple time frame, and at the lower level time frame it will start to build, it will start to build the movement, the momentum at that lower level time frame. So see, try to remind yourself that I need to flip my chart to the lower level time frames. Now there is another strategy called breakout trading strategy. So breakout trading strategy is about, just like it says, breakout, price breach key support. So is you apply this with the support and resistance technique. So key support, when the market breaks the key support, you enter short. When the market breaks the key resistance level, you enter long, provided you understand what is the key support and key resistance. And the what is happening, the potential trend reversal. So when the key support is being broken, the trend is um, possibly the trend is changing. So the trend is changing, and now the new, maybe the trend is already changed long time ago, and it reached a key support level and it's subsided. The market action is subsided and it's just trading at that level. And people are thinking, okay, this is the support level and market will go up. Some positive news come, and then the market bounce up, and eventually a new support, new negative news come, or overall the market is bearish, and then the market just crash below the support. So now you have a new level for your stop. So that's where you enter short. So breach key support level, you're entering short. Breach key resistance, you're entering long. And potential continuation of trend. So the support is broken, let's say, so continuation, and the previous trend was a short, and the key support is broken. So it's a continuation of a previous trend, which was to the short side. So understanding the breakout strategy is a capitalization on the trend reversal. So the trend was to the downside, and it tried to change to the upside, and then it failed. The new news came, and the market just continued to the downside, and just you can reverse it to the for the other side of the trade, the trading. So types of breakout strategy. So think about it, breakout above resistance, so continuation of a bullish trend. So the market, let's say Apple, the 200 resistance, 198, 200, and it breaks 200, it goes to 210, 212, etc. It just keep going, and then it falls to 200, it stays there, and then it continues, it falls to 198, and then it bounces back above 200, and then it's a continuation of a bullish trend. So it can happen like that. Break below support, so let's say 190 support, so it breaks the one support, so continuation of a bearish trend, and the trend, let's say, established already that it's the Apple going to reverse. Now, another one is a breakout retest. Wait for retest, then enter in a position. So if you identify a resistance level, and the market is trading below resistance, so you don't want to enter. So if the resistance is at 194 and it's trading at 188, so it's a 6 point. It's like 6 floor above. So if you jump, you will lose your leg, you will die, because the resistance level is so high and you entering short. So you wait for the resistance to test. So the market goes to that resistance level, 194, and then it starts to break down. That's where you go and short that trade. So, or same phenomena for support. So breakout, retest, wait for retest, then enter in a position. So these are the breakout strategy. So application in trend reversal, so capture trend reversal. So opportunities for profit. So you're capturing the trend reversal. There are opportunities for profit. Confirm breakout. So breakout, just don't apply the breakout based on just the price. So use some kind of a volume, some indicator, some strength testing. So do some strength testing. Just don't use the price indicator. The traders who only use price and do ignore the volume, they are only seeing the 50% of the picture. You need to see the complete picture. So it's like you need to go around, see everything, complete picture, drive around, circle like a roundabout. You go over a roundabout. Okay, this exit, that roundabout. Okay, you confirm everything. You saw the price, you saw the volume, you have a news. You are pretty sure that this is a confirm breakout or breakdown. And then how do you the target? So set the price target by measuring the height of the breakout. So the previous distance it has traveled, figure it out that distance. Whenever the stock break out, it travels this much. So add that distance to the price from where it's breaking out. That would be your target. So measure the height of the breakout. So see if you can figure it out the previous distance it travels when the breakout occurs. So that's the distance you need to add from the current price breakout for your future price target. Now, there's a limitation. The false breakouts, false signals, potential losses. So a lot of breakouts are false breakouts. People go for breakout 52 in a week. The stock is making a 52-week breakout. I'm going to go long. Or somebody tells somebody that go for a 30-day breakout. So I'm applying this 30-day breakout. And when the stock does 30-day new high, I'm going to go long. And that's where they enter when the stock is about to reverse. So don't just uh, apply the breakout techniques, willy-nilly. Just don't do that. Apply volume, other techniques, etc. Wave sawing, sudden reversal after breakout, frequent exit. You enter in the breakout and the stock tanks and takes you out. Then you say, okay, this time is a genuine breakout. So this time you go and then it comes down. So when the breakout is happening, also keep an eye on the overall market. It may not be that this has to do with the market. It has to do with not with just this particular market, but overall market. So, and on top of that, volatility management. So consider volatility of the underlying. So what kind of a stock you're trading on a breakout? Are you trading Tesla, or are you trading GE, or like AT&T, or Verizon, etc.? What kind of a stock? So if it's a volatile stock like Tesla, you need to have some kind of a leeway. Look at the average true range, the stock on average on a particular day, on average it moves. So take help of a 14-day, last 14-day moving average, or the last 10-day moving average, how much stock moves. So don't go and bet your farm on such breakout, because people make a lot of money trading all these kind of stocks on a breakout, and then eventually they get caught, especially when trading options. So they just keep buying option in Tesla, keep buying, and then everybody is happy. They're just buying it on the phone. Okay, buy Tesla, call weekly, this breakout. So just adding, and then eventually everything is done. So don't do that. Adjust properly and read the market correctly. So now the breakdown trading strategy. So just like breakout to the upside, breakdown is to the downside. So prices break key support levels. So prices breaking key support level. Now the prices can break the previous resistance level. So if the prices broke the resistance level and it went up and you went long, and now the prices break that resistance level and is going below, which you thought is support now. So that is another strategy, that you think the market broke the resistance level and formed the support, and now it reversed. So market have a thousand ways of deceiving us. So think about it, market have a thousand ways of deceiving us. So there is a big chapter or big presentation I intend to create on how we get deceived, on a deception. So, there is a deception going on in the same way the deception is in the market. So market have 1,000 ways of deceiving. So deceiving is market breaks certain resistance level, it goes up, and then it traps everyone, and then the sell program kicks in, and the order is already there from the journal that fire, when the Apple reaches, let's say, 205, unleash, the word unleash the cell program, and then boom 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 boom, everybody, the one guy is selling it, and then another guy gets the news that this company is selling, this hedge fund is selling Apple, I don't know, God knows what, maybe they know something, let me sell, ask question later, shoot first, okay, sell. So if that happens and you see it, you need to act on it, to exit. So capitalize on bearish trend reversal. So uh, be on high alert. Types of breakdown strategy. So the breakdown strategy, if you're watching pre-market action, you will see there's some news there. So when there is some news and the market is tanking, so be careful when there is a news, let's say earning news or some other news, and the market, will gap down. I'll talk to you about the gap up and gap down in a few slides later. So let's say the market has a negative news, and the market is gapping down, and you're getting ready to, or breaking down support level, and you're getting ready to buy some puts or short. So remind yourself that you may be too late, because the market is already gapping down or breaking the support. You may be too late so look at it. If you're watching that action on a pre-market level, then look at that price and open your day chart and see that, okay, when the market opens, where it will open, where it will land. It's like a twinkle twinkle little star. It will just land there, or it will be like boom boom boom, like a waterfall decline. And the waterfall decline is happening, and the longer you wait, the more you miss out on the trade. And if the waterfall decline is happening, remind yourself that this waterfall decline can stop anytime. Somebody will see the value, and they will unleash their buy program. Somebody has an interest in it for the market to stabilize at that price level. Somebody gets the order that, hey, don't let this stock go down this price level. So a lot of breakdown happen, and then they just bounce up. So be careful. So there's another story. So be careful when you're doing the breakdown below support. So know the support below the support. So it's like, know the basement level. Sometimes, when you go to the building and you park in the car, it says B1, the B2, B3, B4. You could keep going circle by circle, and then when you park your car, you ask your daughter, hey daughter, what B level we are? Can you tell? And she says, Daddy, we are in B7. Okay, take the picture of this pillar. So that's the way the market goes, and sometimes it just stops. And then you say, okay, it just stopped right there when I entered in a short position, and the market has just stopped. So when you entering the breakdown, make sure you have an intraday chart and be on the lookout for sharp reversal to the upside. So somebody recognize the price as a fair value, or somebody has a big interest in it, and they don't want this stock to go down because it may affect the indices. So when you're trading the breakdown, um, watch all this. So usually the breakdown below support is expecting bearish continuation. Breakdown retest, wait for retest, then short. So the first time when the stock breaks down, maybe remind yourself this is the first time the stock has broken down the support level. So I shall not react to the first time. I shall wait for that support to be tested. So when the market breaks the support, it will subside, and then it will go up. And if it goes up and that support is now resistance level, so remind yourself that the support was broken and this support is now resistance, and it needs to test. When it tests and then falls, that's where you have a clear cut exit point. That, if the stock again bounce up and cross that support, which is resistance now, then you need to exit from the short position. And the momentum, so use some momentum indicators, some volume, that the breakdown is happening with the volume, some volume is happening, and then the volume should not be such that there is so much that nobody is left to sell. So it's not the stock trades on average 1 million shares, and now it's trading at 10 million. So imagine if the stock trades at 1 million and now it's trading at 10 million and you're entering short, maybe you are the last one shorting that stock because there's nobody left. And now it will subside and it will do its thing, and slow, it will waste your time, it will kill you, and eventually it will take 2 months to recover. But if you have a short position or if you have puts, it will expire worthless. So combine all that for the breakdown strategy. Now, application in trend reversal. So capture bearish reversal, expecting bearish continuation. So when the breakdown is happening, you're expecting a bearish continuation. So the stock is already bearish, and temporarily it subsided at some level. There was a news, and now all the positive news turned into bad news, and now it's going down. So set the price target by measuring the height of the breakdown. So look at the price chart and see how much it traveled before when it broke down. So that's the price you need to add from the level when the stock is breaking down. And manage risk, implement proper risk management techniques. What happened when the stock breaks down, it doesn't give, sometimes it doesn't give you the time to exit because the reversal is sharp. And the reversal is sharp. There's the bad news turn into good news. There's a new news comes, somebody's announced something on, let's say they come and they say, we are taking these measures. So when they're saying like this, the keyword they are, we are taking these measures, um, by the time you realize, it's too late. So be careful when you're shorting the breakdown. This is a risky trade. If provided the overall market is bearish, so then you're making triple digit gains in your puts. You buy today, you sell tomorrow. So limitation and risk management. So false breakdowns. So there are false breakdowns happen all the time, and sharp reversals to upside. Key levels of positive news. So some key level reach and you did not read it correctly, or some positive news came out. So use the confirmation indicators like volume and other indicators to understand that this is a true breakdown. So there's something called true breakdown, and then there's just a breakdown. So true breakdown happen when there is a strong support, very, very strong support, and the market is breaking. So look for a very, very strong support breakdown. So it's called true breakdown. And consider the market volatility and adjust your position size, because we are shorting the stock and we making money, looks everything good, buying 50 puts, 100 puts, etc. And then when the market reverses, then the same 50 puts, 100 puts is causing damage. Now there is another technique called gap trading. So I do that gap trading. Gap trading is very specialized. So you cannot um, uh, when you're starting your trading career, you cannot just go, okay, I'm going to do the gap trading. So gap trading is also called window trading. So window open, window close. So think about it, window open, window close. Some window they open, they never close. Some window they open and they close quickly. So what is gap trading? Is exploiting the price gap. So the market opens today higher than the close yesterday, or market open lower than they closed yesterday. So almost all of the stock, they do gap. So 9,000 stock, they gap up. They don't open at the same price at the price they close. So the gap need to be a meaningful gap. So what is meaningful for you? So you have to set certain criteria like 1% gap, 2% gap, or a $2 gap, $3 gap. So have some criteria of gap trading and set that criteria to capture those stocks which are gapping up or down. So basically, gap trading is exploiting the price gap. So market open higher or lower. So gap is a unique trading opportunity. And the gap is occurring if the market is gapping up is due to some catalyst. So there is some catalyst and the market is gapping up. And then there are many kinds of gap, continuation gap and exhaustion gap and the breakout gap. So so you need to understand what kind of a gap you are trading. Is it exhaustion or continuation or the breakout? So most of the money is made at the breakout gap, which occurs at the initial stages when there's a new catalyst. A new catalyst could be a new product. A new catalyst could be the CEO got fired, there's the catalyst. Just because he pinched his secretary and he got fired, and nobody liked him anyway, and he, on top of that, he pinched his secretary and he get fired. When he get fired, the news is out, the CEO is fired. Okay, now this is a turnaround game. So there is a game changer now, and the market likes it, and the stock gaps up, and then it's just boom, 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 or just, or they close a certain division. We are wrapping up our market in this country. The market likes it, and the stock gaps up. So know the real reason for market gapping up, and at from what level is gapping up, and how big is a gap. If the gap is big, you have already lost the opportunity. So now you need to wait for the gap to get filled. However, the gap trading is a unique trading opportunities. So what kind of a gap? So gap up trading, gap down trading, and then gap reversal trading. So there are three kinds of trading: gap up trading, gap down trading, and then the gap reversal trading. So which one suits you, and what kind of a market is there? If if um, if if the market is bullish, then you're looking for a gap up trading. If the market is bearish, downtrending, then you're looking for a gap down trading. If you're expert and the market is choppy, you're looking for gap reversal trading. So who you are, what suits you, and what kind of a market you are trading. So if the market is bullish, you're just looking for gap up trading. You're not looking for gap down trading, because the market gaps down, it gaps down, and then somebody will think it's a fair value, it's a good value, and they will start buying it, and then you lose money trading gap down. So why bother trading gap down stock when the market is moving up? So don't do that. So identify the market and then just focus on a good gap up trading or gap down trading. So the the gap trading is application in price discontinuities. So capture quick profits. So when the market is gap up and you recognize it, so when the always, that's why you need to look at the intraday price. Doesn't matter if you're trading gap or you're not trading gap, because the intraday chart will tell you if this stock has gapped up today and how far, because the intraday chart is telling you clearly where it closed yesterday and now where it is today. So the candidate which is looking good on a day chart, suddenly it looks bad on an intraday chart, and then you say, oh man, it closed at 90, and so it's trading at 9, it's, let's say it's trading at 96, and you say, oh, this is looking good, it's gapped up, and I will sell at 99 and 100. But you fail to realize, you didn't see it clearly on a day chart, that yesterday it closed at 90 level. So there is a 6 point gap already. So it has done its move already from the opening. So you're too late. So 6 point gap. So don't trade. Have some meaningful gap, and then trade accordingly. And when the stock is gapping up, the next level is where it's going. If it's trading at 98 already, and psychological number is 100, so you say, okay, it's trading at 98, and I'm gonna go make some money in it, buy it. Well, the 100 is a psychological barrier. It acts as a resistance. Everybody will sell, not on 100, but they all know they will start selling at 99, and you went in at 98. So for $1 gain, and then it comes down and fill the gap, and you're losing money. So don't do that. Be careful on the gap trading. So the gap trading, the market, when it gaps up, it needs to gap above the resistance level, some kind of a so remind yourself, did it conquer something today when it gapped up? Did it cross the line? So it's like having a river. So there is a movie, no country for old men, something like that. I watched like 10 times, and I forgot the name. So no country for old men. So in the movie initial scene, the guy, he goes to the river and he's trying to find uh, some drug money or whatever. And then the bad guys come and they unleash their dog, and the dog is chasing him, and he goes and jump in the river, and the dog is chasing him in the river, and then he has a gun, and then he shoots the dog, and the dog dies, and he goes and cross the river. So he conquered the river. So same way, and so this is one story. Another story is the same guy is sitting on this side of the river, and the bad guy unleashed the dog, and he has a magic carpet, and he sits on the magic carpet, and he jumps on the other side and says, come and get me, and the dog is just waiting on this side. So the gap trading is like that. If you recognize that this stock suddenly sat on the magic carpet and jump on the other side of the river, and this river is so strong that the stock will not come to the, even if it comes to the river, the channel, it will stay in the river and then it will move up. It will not come on the other side where the dog is. So when you recognize that the stock has jumped on the other side of the river and is continuing, that's the trade you need to take, because now is, cross the river, now is green, 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 and the dog is on the other side, he cannot get me. So identify market sentiment, the potential trend change. So see if the gap has occurred and the trend has changed. So the previous trend was something and now it's changed, or some brand new catalyst occurred. So the stock is already in uptrend and suddenly it gaps up again. It gapped up last week and now it gapped up again. So that's another gap. So market can gap 2-3 times and then it dies. So check when you see the gap, you see how many times recently it has gapped before. If it gaps up quite frequently, up and down, then it's not a good trade. Also, if the market has gapped down, let's say yesterday, and today it gapped up, that is a solid trade, because why the stock gapped down yesterday, now it gapped up. So yesterday it gapped down, today it gapped up. So now you have a clear cut exit. So whenever you find that clear cut exit, the low point of the yesterday's gap, you go long, because the sentiment has changed. Yesterday it gapped down, today it gapped up. So set a stop level beyond gap to manage risk. So understand, don't when you're trading gap, you don't trade, put your stop in between the gap level, because it can come down and fill the gap and takes off, and then you get stopped out. So know the distance, and you are willing to bear that distance. And if you're not willing, so everything is willing, provided how much dollar you're going to lose. So that distance, if it's far, you will buy less shares, because when you're going to lose, you will lose less shares multiplied by the dollar point. If you put 1,000 shares and then the gap is big, you're going to lose big. So know the distance and buy the shares accordingly, buy the option contract accordingly, because when you lose, then you will lose not because you will lose because of technical reason. You will not lose because of your own reason of your greed. So think about it, you're not going to lose because of your greed, you're losing because of the technical reason. Whenever you're losing because of your greed, that's where the problem is. So limitations in risk management, gap fills. Not all gaps continue. So remind yourself, not all gaps continue towards the gap. They get filled. So when the window open, window close. So when the window is getting close, where the window will get close. So identify that level where the window will get close. That is the first line to go long or enter in that position if you're not in the position, or add more to the position when the gap is getting filled. Now, if the gap is big, you enter, you have overnight risk. So identify that there is an overnight risk. Significant news or market development have occurred. The market gapped up. Tomorrow something else can come and it can negate. Um, so timely execution of the gap is required. So timely execution. So there is a technique I use called opening range breakout, which I will explain in some other time. So opening range breakout, you use the opening range breakout to time the gap. So timely execution is required for gap trading. So specialized techniques you need to use to gap trading. So be patient, remind yourself, okay, this is stock gapped up, it gapped up from the proper level. I recognize it, it is a proper level. Now it's a matter of entering. So if you are not sure that this stock will give you a chance to enter, you initiate little position, because if you're right, you're right, you are going to make money. So initiate some position, so have some skin in the game. So you say, okay, I'm gonna buy some 100 shares, although I want to buy 500, but I'm going to buy 100 shares. I will have some skin in the game and let the market come to me, and 400 shares I have the the allocation, and then I will add more to it. So focus on capturing price movement, reversal of initial move. Look for the initial reversal of initial move. So when a lot of time the gap just open and then it pulls back. It pulls back to certain price level. Watch the intraday level chart, and then when the reversal, you identify the reversal, that's where you initiate a position. And if you cannot wait, just buy something and then rest by identifying the key levels. Focus on your lower level time frame. So type of gap reversal trading. So gap up reversal trading. So um, the reversal, so that was gap up and gap down. Another thing about the gap down, I think I did not cover gap down. So I'm not sure. So gap down, most of the time when the stock gaps down, like, it shows in the pre-market um, session. So you're watching the pre-market and you see the price, the stock will gap down. Most of the time, the stock gaps down to some key level, some 200-day moving averages and 50-day moving average. Something happened and it gaps down, and the move is temporary, and then it starts to move up. So that is the time where you do the gap reversal. Instead of going shorting that stock on a gap down, you are looking to go long on a gap down because it's gapping down to a certain price level. So if you turn your attention to the shorter time frame, 5 minute, 10 minute, you may see the opportunity on a gap down reversal trade. Now, the reversal trading is a gap up reversal trading is selling short, anticipating bearish reversal. So just to give you that dog and river analogy, so it's like this: the guy jumped in the river, and there is a video I saw. There's a bear sitting on the side, and the dog jumped in the river, and no matter where the dog tried to swim, he comes back to the river side, and then the dog, the current takes him back to the river. So it's like this. uh, you don't want when you are gap up reversal trading. So if you go long on a gap up, you make sure that it's not coming back to the river on the other side of the river. Uh, so watch the initial price move. Sometimes the stock just gaps up for no reason, and it just sit there, and the candle is small, the volume is not there, it just gaps up, and eventually it tanks. So when you recognize that the stock gaps up, not on the other side of the river, not on the other side of the reversal resistance level, maybe that's the you if you have a clear cut level, you may want to short that stock or buy puts, anticipating bearish reversal. But it's a dangerous trading technique, especially when the market is bullish. So don't try not to do that. Now, another one, gap down reversal trading, is when the stock gaps down. Yeah, this is the one, gap down reversal, going long, expecting bullish reversal. So the market gaps down to some 200-day moving average, some support level, some 200-day, 250-day, and then it just starts to move up. But if you trade gap down reversal, unless the momentum is big on the other side, like a V-shaped recovery, you don't want to do the option trading on a V-shape because V-shaped recovery may not happen, and then you lose. You eventually, you're right. You identify that this gap down occurred at the key support level, and it will reverse. So we are not in this business to be right. Feel good. I was right, but you are right. Like 100 days later, you need to be right away. So don't try to buy calls on gap down unless the momentum is so fast you can recognize that the reversal is sharp, and your calls are making money right away. There's another strategy called gap fill trading. So price gaps fill partially or complete. So the window is open, the big window. Let's say the stock gaps up from 100 to 106. So there's a gap between 100 and 106, and the gap gets filled. So when the gap gets filled, you recognize it. The gap gets filled, and you are going long. And the logic is, a lot of traders, when the stock gaps up from 100 to 106, they see it and they are not in the trade. They're having a remorse. So this emotion called remorse, they have remorse, and they don't want to buy 106. They say, no, when the stock comes down to 100, I will buy. So when it eventually it comes down to 100 for some reason, they unleash their buying program. So when the gap gets filled, you may go long, so partially or completely. Now, uh, the gap is a reversal is a trend reversal. So gap reversal is a trend reversal. You need to use the signal, some kind of a confirmation signal, the volume. So volume needs to build on the downside. So if you're trading gap up reversal, the volume should build on the downside. So you need to do the price volume analysis and say, okay, the the volume was low on the gap up, the volume is high on the downside, the reversal, and have a clear cut exit point. And the clear cut exit point could be the high of the gap. So if the stock gaps up at 106 and you went short on 104, then 106 plus some points, 50 cents, 60 cents is your stop loss. If it goes above, then you are out. So in setting the price targets, so measure the height of the gap where it all began. So if the gap occurred significantly from 100 to 106 and you are entering short at 104, then your ultimate price target is 100, 150, something like that, because that's where the that stock will subside and may just rest there. So identify the height and apply the or support levels and set your target there. So now the gap, when you're trading the gap reversal, it could be a false reversal. So be very careful about trading the gap on the other side. Don't try to be hero. You don't have to trade. We don't have to trade the other side of the gap, because most of the gap, when they're occurring for some reason. So unless you're sure that this gap occurring is false and there's no reason for it and the market is tanking, then trade. Otherwise, avoid the gap reversal trade. Market volatility, consider market volatility, adjust your position size, and timely execution. For gap reversal, you need to be really precise. Act like a day trader, not like a long-term trader on a gap trading. So you must act quickly and take action. The longer you wait, the when you exit at a loss, your loss will be bigger, and you will give back, and you will make less money. So the execution has to be flawless and right at the right time. And the stock gaps up and it starts to break, and you can clearly see and have a confirmation indicator. Now, there's another technique called intraday reversal trading. So, intraday reversal trading is a potential trend reversal within the trading day. So, the reversal happened the same day. So, the market, let's say the market tanked, and now suddenly the market starts to move up. It hits some kind of a support level. So this intraday reversal is popular for day traders. Is also, you can use it for in swing trading, when you can clearly identify the reversal on a day. For me, is on a day chart. So on a day chart, some kind of an indicator, some kind of a pattern like a hammer or something happened where I can clearly see that the market hit the support and now it's moving up. Or overall, the market was bearish, and this market also some news came and the overall market pulled back, and this stock pulled back, and it has no reason for it, no bad news associated with this stock, and now this stock is reversing to the upside. So it's at that time you can apply the intraday reversal techniques. So now the types of intraday reversal is a key reversal, make new highs or lows, and but close in opposite. So when the market makes a key reversal, which means it makes a new high and then it closes in the opposite direction and it close negative, that is a key reversal. So if you understand the key reversal, you can apply, or the market make a new low but it close in a positive side. So that's the key reversal. So when the key reversal happens, that is the intraday reversal. Some kind of a pivot point. So if you have formulas for pivot point and you believe in those formulas, such as let's say high plus low plus close divided by 3, this is my pivot point, and it hit this pivot point, which is act like a support. Popular with the day trader, help with pivot point. You can take help from support and resistance level. If you can identify that this stock was breaking down and now is reversing to the upside, so that, and I know this is a very important support, and I go long. So you go long. So you have your strategy nailed down and you're applying it. You can take help from the candlestick patterns such as doji, engulfing, and others. So if you master the candlestick pattern, you can apply those and trade accordingly the intraday trades. So intraday reversal is for capturing the short-term profit. So sometimes the profit is big, huge also, because the stock just keeps going up and up and up and after tanking, or the stock just keep going down after moving up short-term. So capture short-term profit, but most of the time is a short-term profit. Manage risk, set tight stop loss orders. So for intraday reversal, the market will tell you quickly. The result will be out like quicker, that you are right or you are wrong. So think about it. The result will be announced soon, within an hour or 2 hours or tomorrow. So set type stop loss order, confirm signal strength. So when you are applying the you trading intraday reversal, use some volume techniques, or take help from some indicators, whatever you have, and validate the strength of the reversal signals. So use that, combine it with other techniques, because the false signals happen. The market looks like it's doing the intraday reversal, and then eventually it tanks. It goes the same direction which it was going before the intraday reversal happened. So when that happens, you will incur the loss. Market volatility, erratic price movements after the intraday reversal happen, and then suddenly the stock just stops going. Let's say it's going up, and suddenly it stops going down, and then it starts to move up, and it's coming very close to the low of the day, and then it reaches very close to the low of the day, and then it starts to move up, and then it makes a new 30-minute high or something like that. And so it's up and down, up and down, and then the action resolve either to the upside or the downside. So there could be a lot of erratic price movement, so you have to bear it. There could be a news, etc., comes coming during that erratic price movement. That's the reason the market is acting like that. Avoid overtrading, excessive losses if not managed properly. So in the intraday reversal, because the movement is so sharp and quick, and it's not 100%, it's not a reliable, nothing is 100%, but it's not reliable. So you need to trade um, at a smaller position level and control your emotions. So emotion regulations is required. So pay attention to the emotions you're going through at that time, and you should be able to control your emotions. That and if this doesn't suits your style, then just avoid intraday trading. Now, the last one is, so I have gone through like 12, 13 strategies, which I use in my trading. So moving averages, breakout trading strategy. So moving averages breakout is a moving average breakout. So moving averages act as a dynamic support or resistance level. So try to understand, there is a static support or resistance level, and then there is a dynamic support or resistance level. So static is, which I talked to you about, in the graveyard where the battle was fought. So that is the static support and resistance, and they act. It has a higher reliability than these dynamic support or resistance level, which are moving averages. Moving averages are getting adapted as the market is moving up and down, so they act as a support or resistance level. So take people trade moving averages, crossover, moving average bounce, or things like that. So there are various techniques: moving average, simple moving average, exponential moving average, a Bollinger Band. They use moving averages. So when you are trading trend trading, when you're doing trend trading or breakout trading, you can combine the trend trading and breakout trading along with the moving averages. So you say, okay, the trend is established. Now this stock has moved down to 10-day moving, exponential moving average. Now it's bouncing up. So that is your entry point. And the stock has already been trading to the upside, or the breakout happened. Now you're just waiting for your entry. So you're timing your entry based on the moving averages, which is 10-day exponential moving average, or 8-day moving average, or crossover of 3-day moving average over the 8-day moving average. Whatever is your thing, you're applying it for moving average trading. So, and the price crossing above moving average or below moving average, and you set your alert. When the stock crosses below 50-day moving average, I'm gonna go short. Or when the stock goes above the 50-day moving average and it sits there for 2 days, that's my thing, and I will go long, because it's crossed the 50-day moving average and it's sitting there for last 2 days. So I have a good reason to go long. So if that is your strategy, then that is your strategy. So there are strategies. Moving averages crossover, such as 50-day moving average crossing 200-day moving average, so golden cross, or what is it? The other side is a a crossover from hell. The stock is going down, so that is doomsday crossover. So whatever it is, moving average bounces, act as support or resistance. So if you believe that the 21-day moving average is let's say 22-day moving average, because there are 22 days in the month, trading days in the month, so I will apply 22 trading days moving average. So I apply it and I believe in it, so acting as a support, and I go long. Moving average envelopes. There are moving average envelopes which use two moving average with a percentage difference. So if moving average envelope is your thing, you apply moving average envelope to trade. There's an adaptive moving average. There's a weighted moving average, simple moving average, exponential moving average. So do the study on moving averages. So application in identifying trend continuation and reversal. So capture trend continuation. So you're applying moving average to capture the trend continuation. The trend is already there. Now you're just taking help to time your entry in via moving average. So price breaks above or below moving average, showing continuation. Identify a trend reversal, price break above or below moving average, showing reversal. So is going the other way, showing the reversal, or is bouncing up, showing continuation. And then set your price targets. So figure out a way of setting the price target. So distance from the entry point, so from the moving average to the next key level. So that next key level needs to be further away, somewhere which is good enough for your profit target. So if you're entering at 100 and it's a 20-day moving average, the target is like, let's say 106 or 110. So you figure it out the next key level based on some techniques, whether it's a resistance level, or you use Fibonacci, or you added the height to the entry, and then you say that's my target. So limitations are false signal. So moving average can give you false signal. You just there are 365 days in the year, so there are 365 moving averages could be. For you is a 20-day moving average. For me is 22-day moving average. The guy sitting in Timbuktu or Fiji Island, he is using 39-day moving average. God knows what moving averages people are using. And then if you see there's a lines and lines on their charts, like 100 lines, and the stock will eventually fit some moving average. They have a Bollinger Band, they have this, they have moving average, they run out of color. So they color their moving averages, they color their lines, so many, they run out of color. They're trying to figure it out that, okay, what color should I give to this line I have? So if you are having that kind of a trading, it's not good trading when you are running out of the color option. Like color option, oh, I ran out. I use yellow, blue, green, pink. Let's add the red color, the brown color, and then you don't even know what color is what. So if you have that kind of a trading system, I don't know, it's not good. So market volatility, so moving average can give you false signal. So use some combination of other indicators. Use some confirming indicator, some evidence which confirm. It's like, did you see him sitting in the McDonald's? Yes. Okay, you go also. You confirm that he was really, like, you see the detective movie. They confirm. Yes, confirm. The target is in the McDonald's. So that's what it is. You really need to confirm that this moving average is giving you some, it's just telling you that moving average is bouncing, but do you have some other confirming signals to tell you that this is a real signal? So that was all the strategies I used, and there are many more. Now, not only on top of that, so many strategies there, so many stocks in the baskets. So how do you come up with just few? So I cannot go into detail, it's already 2 hours. So there's something called price and volume filter. So you need to apply price filter. You are interested only in a stock which is 20 30 price level and above, you need to apply the filter for the volume. The volume needs to be 1 million on a daily basis, and right now it's 600, so you apply that. Average true range filter, so the stock needs to trade certain dollar amount on a daily basis, otherwise you don't trade. You can apply the filter, the price change, this many dollar amount or this much percentage, then you pay attention to that stock price change, certain volume. So the stock trading 500% of the normal volume right now, so you need to pay attention to that. So all these price and volume filters you need to apply. Then all kinds of alerts I get, you need to keep an eye on your open position, that is it making a new intraday high, new intraday low. It is already trading 30% of the normal volume. It's only 15 minutes, but it's already trading 30% normal volume. Something is going on. There's a news there. Above average volume, below average volume, breaking the resistance, breaking support, sharp reversal from resistance, sharp reversal from support. So all that goes on during the trading hours. So after all I do this and I send you the trade. So let's say I send you the trade of Meta call September 310, buying to open at 10. So this is a simple, this is the simple one line I send you. Meta call September 310, strike, buying to open at 10. And then in the body of the email, so this is the text message, and in the body of the email, I describe it like that. The stock is Meta, month is September, strike 310, type call, action buying to open, suggested price 10, and always buy third Friday expiry option unless I specify. So this is the alert you get. And then you set the limit order, day order, don't set the GTC order. So you set your order to get filled and you get filled at that price. So after you get filled, then you receive the targets. I send you the target email. Now there is a guideline to chase or not to chase. So you can don't chase. You can pay 5 cents extra if the price is between 70 and dollar. You can pay 30 cents extra if it's trading between 6 and 8.50. So I put some guideline there what extra you can pay above what is suggested. Sometimes, most of the time, the stock is not running away. I don't do the momentum trading. So a stock is trading in a certain range, and if it's a Tesla or something, then you may pay 50 cents more because the options are expensive. So options are high price because it's a volatile stock. So pay 50 cents for maybe Tesla, because when the gain is a $4, $5 per contract. And then if you get partially filled, then don't worry, you can you can wait. You don't have to chase the stock or your contracts. It's not like that. You can always get filled next day at a better price. Now after I send you the target trade alert, then I send you the target. So the target is coming. So all these techniques I explain, I apply. It depends on what is happening, and figure out the target. So the target is already known to me before I send you the alert, but then the target is composed, is entered in the system and sent to you. So there are 3 targets I send you, and I call it green, yellow, and red target just to specify, relate to you in terms of traffic signal. Even my little son knows, hey, daddy, the light was yellow and you crossed the yellow light. So even my son knows that daddy is not supposed to cross the yellow light. So the same philosophy in the green, yellow, and red target. So I will explain to you quickly what is green, yellow, and red. So green target is the target which is very high probability of achieving it hit. So if you buy an option, let's say at $2.50, and so $3.40 target is achievable, and it has a 95% probability of hitting. So we send you based on the complex matrix I have. So I've developed a matrix where I know my system is telling me that I need to sell 1/3. So based on all that, I get the alert that I need to sell 1/3. So I send you the alert, sell 1/3, or I send you the alert to sell 1/2, or sell majority of the trade, or just sell all. So if you bought 6 contracts, you will sell 2. And the way the green target is set up, that the stock is expected to continue further to the upside. So the green target is just one target. It has a minor resistance in terms of call. So I send you the alert, sell 1/3 to the members. The yellow target is a target where it's like the stock is expected to rest. It's like okay, it's going to rest over there for a few days because it has some minor resistance. It has some resistance, some meaningful overbought level or some resistance level. So I send the yellow target, and it has a 85% probability of hitting. So its stock is expected to hit and then pull back. So I suggest you sell one half or three-fourths of your position. So I give you the alert, sell half, or sell majority, etc. And I document it that I send you sell half or sell majority. So I already know what I sent you. So when the next alert is sent, it is sent based on what I told you before. So if the stock hesitate to move further, I send you the alert to sell rest and close the position. Now the red target is like ultimate target, which is the big resistance level. So below the resistance level, not the resistance level, and it has a high probability of hitting it. So it's like when I'm traveling from San Diego to Seattle, the Seattle is the red target, and San Francisco is the yellow target, and Santa Barbara, it could be the green target. So think about it. So if it's a Seattle, I will take some time. My GPS is telling me I will arrive in 67 hours, but I arrive like 8 days later. So that's the way red target is, because the stock goes up and down and travels, it's do its thing, and eventually boom, it hits that target, or sometimes it never hits the target. Sometimes you never reach Seattle. You decide to come back way before you get tired, and you say, "Okay, I'm going back home. I'm not going up." So so there was a 70% probability. But I am going to Santa Barbara from San Diego. I have a 95% probability that I'm going to Santa Barbara. So when this happen, either send you the sell rest because I send you alert before to sell some, or sell all. So it depends what it's doing. And I try to jump the train before the train reaches. I'm good at jumping the train before the train reaches. I did that when I was a kid. I didn't need to wait for the train to reach the platform. I just jump because I can see my home there. I say, okay, the train is moving at 2, I just jump. So same way that the train doesn't need to reach the platform, you just jump beforehand. Now, when the red target, remember the river I explained to you. So the red target is like a river resistance. So in terms of call, so the stock when it's reaching Seattle, it needs to, if you are traveling, let's say, and you reach instead of reaching Seattle, you just happen to go on the Canadian side. So you just ended up in a Canadian side without anybody checking your document, and then suddenly you realize, hey, I'm in Canada now. So okay, should I go back to US or just I continue my journey to the north? So if that is the case, when that happens, you continue your journey, you know that okay, you're going up north and you enjoy the scene. So that's the way the red target, the resistance is conquered, and now you are in a new territory. When the new territory is there, the stock creates its own target, its own landscape. So it's a brand new landscape, brand new territory. You are an uncharted territory, so you travel. So when this happens, I send you the revised red target. When I know that you are on the other side of the red target, it's safe to hold. And if it breaks below the red, so if it so happens that you come back to the US side from crossing the border accident, then you say, okay, I'm going to sell it. So you sell and you take the flight and you come back to San Diego. So breaks below red and sell immediately. Otherwise, you just cruise and enjoy the scenery. The revised red target is sent to you because the markets are dynamic. So the cannonball is fired, the market is moving in momentum, it's setting up a new target. So when you set up the new target, you need to be flexible. So I send you the update you that the new target is there. Various reasons to revise the red target. So there could be various reasons to revise. So red target is revised to capture more gains, either to the upside or the downside, depending on the trade. So I send you the adjusted targets. So I fit in, move the target and give you the target. If you are already out, you're out. Don't try to initiate a new position. Just because the red target is revised and you're already out, and then you say, okay, red target revised, I'm going to open a new position. So don't do that, because I may be getting out tomorrow, and you open a new position, and then you regretting, and then you're saying, okay, I'm regretting, why did I open a new position? So don't do that. So multiple exits. So I give you multiple exits. So these are the multiple exits: sell one third, sell half, selling majority, selling rest, selling all. And I also give you, sometimes I give you the sell price range. When the sell price range is given when the market is moving so fast towards that we don't know where it will stop. So I give you a wide range. I analyze the resistance level and I send you the price range that sell between this and this. Sometimes the spread is wide. So I give you the price range in, especially in the option. So I give you the range, or I tell you sell to close by market. So the profit is there, and I tell you to sell by close, because we need to close because it's a long weekend or Friday or something is happening. So I send you the alert, sell by market close. And as a trader, you need to watch your pre-market position. So me and my team watch the market during pre-market hours, and we send you the update on the targets when the stock is moving in our direction, and we see this stock is gapping up or some earning news or something happened, and we see it in the pre-market. We send you the target update. We remind you that these are the targets. So the red target hitting in a, so this is very important. The red target is hitting in a non-regular session during the pre-market hours or after market hours. The stock hit the target, and it is a red target. So what happened, it's the red target was a resistance level, and it's already hitting the, in the resistance level is hitting in the pre-market. So when the pre-market is hitting, the somebody is selling it in the pre-market hours. So we need to be aware of that this was the high in the pre-market. So the market, when it opens during the market hours, it needs to gap above that high made in the pre-market. And when it doesn't, and even if it does and it pulls back, then you need to sell. So when the gap up occurs, I'm very vigilant in monitoring that stock and sending you the alert. If you don't receive it, let's say after the gap occurs and you don't receive it, you are expected to sell majority of your position, because there could be a hiccup in the system, in the trade, and or it may, the email did not reach. So you're vigilant that the stock gaps up big and I need to sell. Some event occurred and it's causing that stock to gap up. There could be any event. So chances are stock will pull back during a regular session. If the stock made a new high, a high in the pre-market, and it's not making a high, the crossing the high during the first 15 minutes, then chances are that it will not go above that high. So you sell. The stock must gap above red for calls and below red for puts, must continue its journey. So all this, I monitor it and I'm sending you the alert. I'm just explaining it that this is what's going on behind the scene. So I'm just explaining what we do. Pre-market alert and strategy is sent to members. So we send you the alert. Now, sometimes there is I send you the alert to buy more. So buy more, because the position is it's like you landed in Canada. Instead of halting at Seattle, you just happen that you landed in Canada, and now it's a brand new territory. So you're cruising. So that when that happened, then I send you the alert to buy more with a different strike, a different month, because we planning to close, maybe trying to close this is strike because it's deep in the money, or the time is running out on this month. So we the trade is good, so we send you to open a new trade. Let's say we have an August trade and time is running out, close the August trade, but this trade is good, so open and with the brand new strike further in, above higher strike with the new months, September or October. Or you can create a vertical spread, so you can short you can sell some contracts to create a spread, so you lock your gains. So you can do many the same trade, or you can buy shares, close your option trade and buy some shares, or you close your this open position you have in this, and you can buy, you have so much profit that you can buy 3 contracts by from the profit you have. So if you have a $300, let's say, per contract profit, and you had 2 contracts, so $600. So you have the 600 profit, you can close the position, and then you are able to buy, open a new position with another 4 or 5 contracts out of the money with the same profit. So you're not risking your own money. So you can do all those things depending on where the stock is. I send you the update. I send you the fundamental reasons also. I prepare a report, I do the study, and I give you the fundamental reason for that trade. So there's a article sent to you via email on the reason to go long fundamental. So it's not only fundamental, it's a lot of things goes on behind the scene, the technical. So combine the technical and the fundamental, become a rational trader, and I send you the fundamental reason. So all this goes on, and if there is any volume update, I send you the volume. This is a new, this is a brand, this is a big topic, volume update. So I teach you about the volume some other time, and I send you the update on that we are ready to log in. So all this goes on behind. Sometimes I send you the alert to buy more. So on average down and average up. We don't average down willy-nilly. We need to average down at the right time. So average down at the right time. Some key levels are being held, so you average down at that level. Just don't average down for the sake of average down, so don't do that. Or average up, so I do average up and average down, so you can do that, and I send you the alert. There's one last thing, is setting the conditional order, which is another brand big topic of setting the conditional order. So just think about it, that the we are trading option, but actually we are trading stock, so we are reading the charts of a stock. So I don't if you buy a option at $10, it's hard to know where it will be in a few days. Option, is it 10 $11 or $12, $13? But since we are reading the stock chart, so we know we are expecting the stock to go to this level. If the stock is trading at 100, it's expected to go to 106. 106 can be hit tomorrow, or it can be hit. If it hits tomorrow, the option price will be something. If it hits 7 days later, it will be something. So dynamically, I am adjusting the option. I give you the yellow target based on the dynamic changes in the stock is happening, and all the Greeks behind the option, I'm adjusting the option price, but it's not 100% accurate, because there's a spread, there's a time decay, and all that going on, is the volatility shrinking and going up and down. So all that is changing the dynamics, but the stock behind the stock is just a stock price. So you can set the conditional order based on the stock target. So I give you 106 target. You can set your conditional order, which says to the broker, sell my contract at market price when the stock hits 106. And there are many kinds of conditional orders, which I explained to you in some other presentation. For now, just think that you can set the conditional orders. So this concludes my today's session. And these are some of the winners. I did not update. These are some last month winners. So I did not update, so don't need to show you the winners. Let me see. Let me see what's. Somebody said hello. Okay, hello, Farsan. How late I'm teaching? I just finished. It's 2 hours, 15 minutes. I'm just wrapping up. Sorry. Ruben saying, great webinar. I have a question. I'm a new customer. I have subscribed to, but it has been messed up. So yeah, so Angel will contact you. I will tell her to contact you, Ruben. So thank you. And what other questions? Uh, okay, what are 3 good reasons to enter a trade? Okay, so 3 good reasons. I've been talking about 2.5 hours. So 3 good reasons. I give you explain. So you see it, you recognize it, you see it, you recognize it. It looks familiar to you. So you say, aha, I've seen this 1,000 times, and it looks familiar to me, and I'm getting a good feeling in my tummy, and I see the target there, and I clearly see the exit point. So that is the reason for me to enter. So enter in that trade where you see the clear-cut targets and clear-cut exit, and you are feeling good in your tummy, and you have seen it before. You feel, and you can visualize all the good scenarios, and nobody is stopping you from taking the trade. All right. So anything? Send me the chart on how much to add to option based on amount. I didn't get it. I don't know. How much to enter is based on, you can create a worksheet. So you can create a worksheet, or you can create a little notepad, and you can enter. So this is another topic of how much to invest in a trade. So based on your risk profile, first you need to know who you are. You need to know what you're trying to achieve. what kind of a portfolio you have, what is the dollar amount, what is your age, what is your risk profile. Once you know all that, so you can answer these questions in one sitting. And then for each trade, you're willing to lose, let's say, 1% of your portfolio. So if 1% of 100,000, I'm just giving you example, $100,000 portfolio, 1% you're willing to lose. So it means you're willing to lose $1,000. So if you're willing to lose $1,000, then you know where is based on your stop. When the trade goes against you and you will cut it loose, you will lose only $1,000. So if the answer is 5 contracts, so if you buy 5 contracts and when it hit the stop loss, you will lose $1,000. So when you lose $1,000, that will be 1% of your portfolio. So that is the number of contracts you will buy. So if you say, okay, I am willing to lose 100% in this trade, if that's the case, then whatever is the answer, then you will buy less number of contracts because you're willing to lose 100% in that trade, and 100% is 1% of your portfolio, so you will buy less. If your stop loss is at 50%, then you will double your number of contracts. If the stop loss is at 25%, then you will buy 4 times the contract which you will buy when you're planning to lose 100%. So depending on, so your portfolio size is constant, it's not changing every day. It's you can adjust it if it's changing every day. You don't need to change, just revise it, portfolio size once a week. So on a weekend basis, you say, okay, this is my portfolio. Your risk percentage is not changing. It stays same, let's say 1% or 2%. So these two things are constant. Third is you're not changing, your objective is not changing. So all these are constant. The variable changing is the stop loss. So the stop loss variable, which is changing, is coming from your trading system. So your trading system is telling you where to exit. So if your trading system is telling you that when you exit, you will lose 100% because that is your technical level. So if that's the answer, then you say, okay, I'm gonna only buy, let's say if the contract is trading at $500, I will only buy 2 contracts because 2 contract means $1,000. And if I lose 100%, the $1,000 will be 1% of my $100,000 portfolio. I'm willing to lose, uh, $1,000. But if you're willing to lose only $500, then you will buy only 1 contract and willing to lose all. So depending on your portfolio size, which is constant on a weekly basis, the risk percentage is same, willing to lose. Only thing is changing is your variable, which is the stop loss. So if you're not sure about the stop loss figure and you assume, okay, I'm assuming in each trade I will lose, let's say 70% or 60%. So based on that, you figure it out the number of contracts you will buy, number of shares you buy. I teach in a little more detail in course, which is the 8-day course I'm starting soon. It's called Duplicating Success. And you can send my team uh, email and they will hook you up. All right. Uh, what most come up like head and shoulder and double bottom? Question mark. No, no. Double bottom. I am not just looking at head and shoulder and double bottom. So what happened? People tried. It's like what traders do is like trying to figure it out, looking at the cloud and trying to figure it out. Hey, this cloud is making a pillow, or this cloud is making a blanket, or there's a castle up there. Do you see that castle up there? So that's the way the traders are trying to figure it out on the chart. Oh, do you see the head? Right here is the head, and this is the shoulder. This is the shoulder. So it may not be right. Or you see this double bottom here. So yeah, it's correct. There is a double bottom, but what actually the stock is doing at the double bottom. So if you just act that because it's the double bottom and you expect the stock to rise, you may get into surprise. So you know there is a double bottom, but what it is doing based on your expectation, is it doing the same thing, or is just you So just don't, just because you see some head and shoulder and you do that. So don't do that. How much to add based on the amount? It was one whole slide. No, that is to chase or not to chase. So this slide you're talking about, this is to chase or not to chase. So you buying more, you chase or not to chase means that when you receive the alert and you don't see that price. So if, let's say, I send you the alert to buy $1.05, and you say what he's talking about, there's no $1.05, it's $1.15. So you can go ahead and buy $1.15 because it's just 10 cents more. So sometimes if the stock moves fast and the option goes to $1.15, so I'm not front running or doing anything like that. So you can wait patiently for it to come to $1.05, or try to shave the spread, which is in between. So if it's a ask is $1.05 and the bid is 95, so you can try to buy $1. It may work and it may not work. So if it's not getting filled $1 and you're haggling over 5 cents, just buy at $1.05. And if it's trading at $1.10, buy some at $1.10. So this is just a guideline. We receive email that, hey, you sent alert to buy at 255. It's trading at 270. It's not 255. So I say, yes, sorry, it moved up. So just buy some at 270 and buy later more at 245. So average will work out. So that's what it is. I'm looking for my edge that I can trade, like Bruce Lee example. Yeah, so create some edge. So the traders who make money, or the filthy rich, they have some edge. So we need to have an edge. If you are, I mean, if you wake up early morning before the market open, 1 hour before, and you meditate, you take shower, you drink coffee, and you stay away from vices, and you had a good sleep, you have an edge. You're not distracted, you have an edge. So these are the edges you have. You journal your mistakes, you have an edge. There's another presentation, another webinar content I've created. I will teach you. If you know your beliefs, how you trade, you have an edge. If you can do mental rehearsals, you have an edge. If you do debriefing after market hours, you have an edge. If you have a trading buddy you can relate to, you have an edge over other traders. If you have accountability partner, you have an edge. If you prepare before the market open, you have an edge. So you have these edges which is beyond you. I mean, within you. You can create. If you're a happy person, you have an edge. So I have a test on happiness I can send you. Take People think they are happy. Actually, they are not happy. So deep down, they are not happy. Many people, they are not happy. They look like happy. So just because people see from outside they look happy, they are not, and it's hurting your trading. So what is the best way to grow my small account? Uh, Best way to grow my account? I don't know. Sorry. I don't know what's the best way. Sorry. Okay. Thank you. So small account. There are 5 C's to trading. I will explain to you in another webinar. One of the C is capital and commitment. So capital and commitment, and then there is the other C's. So capital, the trading is need some bigger portfolio size, not $2,000 or $5,000. It's not for those. So don't trade if you have 2,000, 5,000. Just put it in some series. Commitment. So on a scale of 1 to 10, you need to be at 11 levels, not at 9. When I ask, hey, what is your commitment level on a scale of 1 to 10? And I clearly show the scale is 1 to 11. And I'm just asking this question, your commitment level of 1 to 10, and they say 9. Well, 9 or 10, you don't see 11 on the scale. It's right there. So just because I ask you commitment level 1 to 10, you're saying 10 or 9 or 8. So it needs to be 11. So a lot of hard work. It's not easy. All right. Exxon, we close Exxon. I just won that slide. So that slide is a part of the trading system guidebook. So we have a 71-page guidebook, and I am adding more content. So you can send an email to the team. They will send you that trading system guidebook. It has that page. So you can print it out and keep it in front of you. All right. You want to practice double bottom every day, but how often does it come up? I don't know. You can look at there are 9,000 stocks. So if you look at 9,000 stocks, there will be double bottom in some. All right, I go now. So thank you. It's 7:30. I'll see you maybe in few days. Thank you. Bye.